Hello and welcome to our market alert video for today, which is October 27, 2023. I am Ken Moraif and I'm founder and CEO of Retirement Planners of America. And boy, do we have a lot to talk about this week. So I want to dive right into it. First of all, as you may not know, which because it did not get a lot of press, the US just got downgraded on its debt again by the World Bank. And so that certainly is not a big deal given the size of our economy and the fact that we are the world's reserve currency. But it does add to the jitters that we have already with wars going on now in Israel and Palestine, and then, of course, in Ukraine, and then now with the bombing in Syria that we are now escalating, it appears. Plus the fact that the economy came in with the GDP came in really strong, and that also can cause people to be concerned because it means the Fed's going to raise interest rates some more, most likely. And so all of that, you mix it all up into a big brew, and it makes for a kind of an ugly environment, and therefore we see investors taking money off the table. One of the things that we've talked about over the last several weeks with you in this video is how the investors, the market tends to be a forward-looking mechanism. In other words, it looks 6 months into the future and generally tends to start going up before about 6 months before a recession's over, and tends to start going down 6 months before a recession starts. What could be happening right now is that the investors are looking forward now 6 months. And rather than seeing the Fed lowering interest rates because they've had a soft landing, as people are calling it, and the economy is okay, but inflation has come down, maybe now what's happening is people are starting to reevaluate that and say that not only are we not going to see inflation come to heel, but we could see the Fed raise interest rates some more. And if they raise them too high, then some unforeseen consequence could happen. Or a foreseen consequence could happen, which is that the economy falls into a bad recession and profits fall and the market goes with it. So that is not our base case. As you know, our feeling, our view is that the economy is strong and therefore we should have a relatively soft landing, a milder recession. And we think that towards the end of next year, inflation will trend back down towards 3% again, not the 2 that the Fed wants, but closer to it than we are now. And because of that, we remain bullish with regard to stocks. Now, having said that, we could be wrong, and the first scenario that I described could be correct, in which case then I would ask you, does this environment scare you? Because if it doesn't, I don't know what would. Given how the market's behaving and what's going on in the world. And do you have a strategy to protect yourself against that? And if you don't, should you consider having one? In our firm, we have a strategy we call Invest and Protect. And it's a strategy that told us to sell in November of 2007 before the credit crisis of 2008. Literally, it told us to sell the day before the pandemic was announced back in 2020. And then last year in 2022, it also told us to sell in April. And as you know, the market went down quite a bit after that in 2022. So our strategy, because we work with people who are over 50, who are retired or retiring soon, is to mitigate the downside. We want to protect against big losses because that could cause somebody to not be able to retire when they want to, or if they are retired, not be able to support the lifestyle that they're looking for, that they want to have, because now their money is significantly less. So if you don't have that strategy, we think it is wise to have one. We have an investment principle that says that growth is important, but protection of principal is even more important. So, that I think you get what we mean by that. If that resonates with you, then certainly we think right now we should still be invested in our stock portfolio. We have not sold yet, but at the same time, we have a sell strategy so that if it gets to the point where we feel that things have changed, that we need to get out, that we will. On the bond side, we continue to be bearish on that. We have been out of bonds since April of 2022 and continue to think that that's not a good place to be. Again, GDP came in really strong, implying that inflation is not under control yet, implying the Fed needs to raise interest rates some more. And as we've described in our videos, as the Fed raises interest rates, bonds tend to suffer. And if you're in a 60-40 portfolio, take a look at what your bonds have done over the last 2 or 3 years. You'll see that most likely they've really gotten clobbered. So if you're over 50, if you're retired or retiring soon, we think this is a time to not be in bonds, to be in stocks, but again, only if you have a strategy to get out and protect from the downside. If we didn't have that, we would be counseling our clients right now to not be in stocks. So that's where we are. I hope this video reaches you healthy, wealthy, and wise. And I hope you're not too stressed out by what's going on everywhere in the world. And if you are, hopefully we can meet and help you to alleviate some of that. So thank you for watching this video, and we'll talk again soon.